What's up, renter retirees? For those of you who have not heard, the 100% financing option that we're also stoked about has since disappeared and is no longer available as we anticipated. For those people that have not been made aware, we connected with a credit union that offered a portfolio loan, which is in-house. So this is not a traditional Fannie Mae Freddie Mac loan, but it was specifically an investment product that allowed you to put zero money down or have 100% financing on a property. Super exciting because that allowed you to ultimately acquire more properties with less money out of pocket. You maybe still been out of pocket a little bit with closing costs and things like that. But ultimately what they've done now is they are now offering a 5% down option. And so it's still very attractive. While it does require some capital down, ultimately, this is still a super attractive option to allow you to grow your portfolio quicker and acquire, multiple properties in growing areas that will grow your net worth quicker by being a creative investor, putting less money down on properties versus the typical 20 to 25% that is required with conventional loans. This is going to be an expedited video just to go through the property numbers as far as the strategy and overall, like just philosophy of why to do this and going in the deeper dive of strategy options. Go through and look at the other videos that I've done that are a little bit more in greater detail. Those links will be below. But I'm just solely going through the purpose of one example, which is a Florida new construction. So there's two things to know. One, the credit union is no longer offering 100% financing. Now, we anticipated this to go away at some point in time. We didn't know it'd be this quick. It happened over about 45 days of actually underwriting for that because the credit union hit their threshold for lending. We anticipate the exact same thing to happen probably for this loan product, the 95% LTV or the 5% down loan product. That means that if you're interested in being a creative investor to buy more properties with less money out of pocket, which is always the limiting factor is, down payments, then you need to take action on this now. And you need to fill out a loan application in the link below, and then ultimately find properties that fit your criteria and put them under contract. The next exciting thing to know is now that we can use this loan product, at least a 95% loan product on Florida new construction. Previously, we were told that the credit union would not be underwriting Florida deals at this point in time. And they've since come back and said, now we are. Now, it still takes an exceptional amount of time to get communication back from the bank and get an approval just because of the sheer amount of volume. There's literally one office that does all the underwriting that's based in Alabama, no matter where your properties are located. So it's still really poor communication with the bank. But just know, if you're interested in doing this, at least get your application in. That way you qualify for this loan product if you ultimately want to do it before it goes away. And you're back to putting 20 to 25% down with conventional financing. So let's just go through this real quick. We're going to be underwriting a property in Lehigh Acres. This is a new construction property. The purchase price is basically $322. Single family rent is $2,650. This is a 4-bed, 2-bath. You can see the interior of the house, beautiful home in a great location in Southwest Florida that has strong appreciation both in market value and rents year after year. This is all, remember, pro forma is all based on we're using a conventional loan example in this structure that we found. So when you see a pro forma on our website, it is showing a conventional loan structure. We're going to look at the 5% down option in a second. And remember, pro forma is year one analysis. I cannot stress that enough. We built our wealth calculator available on our website under tools to allow you to project in year 2, 3, 4, and future to see, what your cash flow is going to be, what your equity position is going to be, and what your return on investment is going to be in the future, because we know that pro formas only evaluate the first year performance. So let's look at this Lehigh property example here. You can go onto the wealth calculator and play around with the variables and the numbers for whatever property you're evaluating. I've already extrapolated the cash flow numbers and the equity position onto this spreadsheet right here to allow you to just have all the information in one place. So this is what we're going to be looking at. So basically, this is a 322 purchase price for a brand new build. This property did appraise well above what the purchase price was, meaning there's immediate equity coming into it, which is also a benefit to investing in new construction right now. Usually you have an immediate equity position when you buy the property, but we're not factoring that in for right now. So let's look at just buying a property with 5% down. 5% down in this case for this purchase price would be roughly $16,000. We know that we have closing costs of roughly $6,000. So, $20,000 to $22,000 is what it would take you out of pocket to buy this property. If you're using a normal 20% down conventional loan, you're talking probably 70K with some closing costs to buy this house. So here you're able to put less money down. If you had, say, 70 or 75K to invest, you could buy 3 or maybe even stretch it to 4 of these properties with 5% down versus just putting it all on one property. So with 5% down, roughly 20K out of pocket, a loan for 95% of the value, you are going to be negative cash flow as you would anticipate for having a high loan to value. The interest rate is a little bit higher than conventional as well. Anytime you have higher leverage on a property, it's more risk to the bank. They're going to charge a higher interest rate. I think right now it's around 8.5%, which is actually fairly reasonable for having a 95% loan product. There's no mortgage insurance. That's also an important thing to really understand. So if you even had, like, say you had a 7.5% interest rate with 20% down on a conventional loan, or if you had anything below 20%, you're going to have mortgage interest. You do not have that here. And that makes a big difference because of the loan value. So here your negative cash flow around $2,000 year one. You have roughly, I think we factor in about a 3 to 3.5% rental increase year after year, which is below the average for this area in Southwest Florida. Again, Florida had 2% population growth over this past year, which is higher than any other state, including Texas. So there's a lot of growth in Florida. We would expect fairly reasonable market appreciation as well as rental increase. So we've usually seen double-digit appreciation and rental increase year after year. We're being extremely conservative in this evaluation. We are factoring in a 6.5% market appreciation and a 3.5% rental increase year after year. So first year, based on the loan details, you're roughly $2,000 negative cash flow. Year one, it reduces to just over $1,000 negative cash flow because of the rental increase at 3.5% per year. And by year 3, you're almost break even. Year 4, you're positive cash flow. So between year 3 and 4, you're probably positive cash flow, which is much more attractive than the previous properties we looked at, simply because the rent to price ratio, like the rents are stronger in Florida, even though the prices are a little bit higher. And then also, we're not leveraging 100%, we're leveraging 95%. So we are putting some money down on these. Your annual appreciation on a $322,000 purchase price, which these will vary between, call it $320 to $360 on the Florida new construction, depending on the location and size. But annual appreciation at 6.5%, roughly $21,000. And in year 2, this is cumulative. So this is adding year 1 and year 2 at 6.5% per year. You're roughly $43,000. Year 3, you're $67,000. And, that just keeps growing. And then you also, this is just on appreciation, but you also have your loan pay down, which is not speculative. This is based on your amortization schedule. You can see that each year. Now, please note that this loan product does not have a prepayment penalty. So you can literally refinance at any point in time. You're building equity rather quickly, just through appreciation and debt pay down. Here's your total equity year after year. So let's say you hold this property for 1 to 2 years or 2 to 3 years, and interest rates take a dip, which would be great. And they probably will over 2 to 3 years. You can easily refinance out because you built enough equity that you can put it into a conventional loan. You can put it back in this loan product with a lower interest rate to likely increase your cash flow. But even if you held this loan, let's just look at an analysis for 5 years. Let's say you held this loan product for 5 years on just one property, one of these new construction properties, you're into positive cash flow at this point. So if you're looking over the course of a total 5 years, your negative cash flow, because some years are positive, some years are negative, over a 5-year hold, you're minus $1,500 for negative cash flow. So you're still in the negative total over 5 years, but barely. I mean, this could easily go away if you had stronger rental increases, right? But really, the key here to look at is your total equity position. So over a 5-year period here, appreciation year after year at 6.5%, you have roughly $119,000 of equity just from appreciation. And then you also have the annual loan pay down that's totaling about $14,000. And again, that's calculated by the amortization scale. So total equity after a 5-year hold is about $133,000. And so you created, just think about this for a second, you created and this is the point, right? This is why this would make sense. You created $133,000 of equity on a house by putting roughly $20,000 down. This really is not about the cash flow. Over the course of 5 years, you maybe had a negative cash flow of $1,500. Even if that was double, right? Even if worst case scenario, that was $3,000. So what? you created $133,000 of equity by putting $20,000 down. Let's say you multiply that by 5, you have less, let's say, because you can qualify for 5 of these properties. You still have to qualify for them with your debt to income and things like this. But let's say you bought 5 of these properties, you can only have 5 investment products with this low down payment with this credit union. Let's say you bought 5 of those. Over the course of 5 years, you have less than $10,000 of negative cash flow, but you would have created $665,000 of equity conservatively at 6.5% appreciation, simply because you're using leverage and you're buying 5 properties. That's roughly $100,000. If you have $100,000 to invest, and it may be a little bit more, call it 110 with some closing costs with each one of these properties. If you can qualify for 5 properties, you have $100,000 and you invest it to have, roughly break even cash flow or negative $10,000 of negative cash flow over 5 years, but you would have created over $500,000 of equity. Does that make sense? I certainly think it does in a growing market, right? Like, you could think about if appreciation, we ran it at 6.5%. We know that Florida is the fastest growing state, and it is a very hot market, especially in Southwest Florida. There's extreme demand for rentals and resales, and there's a huge discrepancy between supply and demand. There's a huge supply shortage, and the population is growing quicker. So we anticipate, simple economics would show appreciation year after year in that area. We've seen it over double digit, over 10%. So we've seen double digit appreciation, over the past 7 or 8 years that we've been evaluating this market. So think about if appreciation was 10%, 15%. We always want to be conservative because everyone wants to be conservative, but just think about that. This is kind of like a pretty conservative analysis, and it certainly makes sense. Think about if it was double this, right? Like, you could create over $1 million of equity in 5 years or less with $100,000 out of your pocket. And then think about selling this and 1031 exchanging. Like, if what I really should do in the next video is do $100,000 invested in this, and then look at a 1031 exchange to buy a portfolio of 20 or 30 houses and, have a 6-figure passive income stream in less than 5 years by investing $100,000 creatively using this strategy. Capital is the most limiting factor, everyone. This is a great way to invest your capital in a market that is growing, to be a creative investor, to scale your portfolio quicker. Scalability is the name of the game. So again, this product will probably be not available within a short period of time. If this is of interest to you and this fits within your criteria, reach out to our team. Let's get you pre-qualified. Put in your application with the link below. Email us and let us know you put in your application, and we'll help you strategize. Remember, you don't have to put only 5% down. You can put 6% down, 7% down, 8%, whatever makes sense for you. But certainly, in my opinion, it makes sense to use less of your own money out of pocket, leverage more of the bank's money, and scale your portfolio quicker over time. Thank you for your time.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.